I know what a lot of different businesses are doing, and I just got a report from one of them that happens to be in the retail-related business. And in any event, it was minus 22% in February from a year ago. They didn't think that was going to happen.
Sales? You mean profit?
Yeah. In sales, profits are down a lot more than that. On the other hand, some of our businesses are still doing fine, but they all are reporting that the new, some of them are living off of orders were placed months earlier and that sort of thing. But it's a tougher world out there in a great many businesses, not in the insurance business. Insurance business should be better this year than last year. That doesn't mean it will be, because we can't predict everything that happens, but on a probability basis, it should be better than last year. And the railroad business is down in carloads carried, but it isn't dramatic. And of course, we've got a utility business, and that doesn't really vary much with things. But overall, I think people that run our businesses that do have any sensitivity to the economy are surprised at where they are now compared to where they thought they were going to be 6 months ago. That doesn't mean the world is coming to an end or anything, because 58 years I've been running Berkshire. I mean, we run into all kinds of problems, but that's what business is about. And we run our business so that we don't depend on everything being hunky-dory always. We run it so that we will be the last man standing. And that's the way millions of people are going to give me their money and tell me to take care of it. We're going to try and take care of it. And if we don't make as much money as we might have if we'd leveraged more or done other policies, so be it. I think most of our managers would say that they are surprised at where they are now compared to how they thought they were going to feel 6 months ago at this point.
And
in a lot of businesses, but not in the insurance business. But I think the people at the railroad are somewhat surprised that car loadings aren't a little higher rather than a little lower, somewhat lower. But most of the stuff we carry is essential, but it reflects what's happening. And of course, supply lines were so disrupted and everything a year or two ago that no economic figures are pure, but I'm just telling you my impression. And I look at the numbers every day. I mean, I look at our Easter sales day by day at the candy store, and I can look at California versus Washington versus Oregon, and I get them the next day. I mean, so I love figures. It doesn't really do me that good to be such a figure nut, but I just like them when I see them. I've been in business running Berkshire for 58 years, and I've never found economic forecasts of any use to the company. All we have to do is keep running every business as well as we can, and we got to keep plenty of cash on hand so that people can keep making intelligent decisions rather than those forced upon them. And that's all we know how to do. And if I depended in my life on economic forecasts, I don't think we could make any money. I don't know how to do it. And people want to get them, so they get them, but it has no utility. When I find one of our companies has hired somebody to tell them what's going to happen in the economy, I mean, they've thrown the money away as far as I'm concerned. I was working, Mark Millard, who handles all the bonds and stock trades for all of Berkshire, was there, and I knew I was leaving town on Sunday night, and Mark says, "What do we do next week?" And I said, "Here's what we do." And on Monday, we always buy Treasury bills. We bought about $2 billion of them. We got a 4.99% bond equivalent yield. But the only question is whether we buy 3 months or 6 months. And I tell him to use his own judgment on that. So Monday, I was here, and he sends me a sheet as to what we did. And I don't change anything. Tuesday, he does the same thing. And net, we happen to be a net seller of $300 and some million, but we could have been a net buyer of $500 million in stocks. And I'm going to be traveling tomorrow, he's going to be operating on Wednesday, and I'm not changing any instructions to him. He's going to keep doing what he's been doing. I mean, we don't make our decisions as to whether to own part of a company for the next 20 years. We don't have any idea what anybody's going to do next week or next month. And when I was buying Berkshire between 1962 and 1965 of control, it didn't really have anything to do with it. All kinds of things were happening in the economic markets all the time, but we haven't changed our course, in 58 years. We just want to buy good businesses and we want to buy people we like and trust and at a decent price, and we'll keep doing that. and we'll keep buying Treasury bills every Monday, and we haven't missed a Monday yet, and we keep all our money short, and we keep it in Treasuries, and we were getting 4 basis points, which was $40 million on $100 billion worth, and now we get almost 5%, which is $5 billion. So we've got 100 times the earnings. But it doesn't make any difference. I mean, that is there to be the strongest company you can imagine, and also to take opportunities when they come along. But Mark, if you're listening, just keep doing the same thing you were doing yesterday and the day before. And I could go away for a couple of weeks, and I would tell them, here's what we want to do on the buy side, here's what we want to do on the sell side, and let's keep doing it. And that's what we do. And some periods, there was a period about a year ago, I mean, when incredible volumes were. We bought 20% of a company that already the index funds owned, 25 or 30%, Dodge and Cox owned 10%. We bought 20% of a company in a month or something like that. Now,
accidental, is that?
Yeah, it was accidental, and we were doing other things too. But now it's a different kind of market, and we can't acquire it the same if we're buying an accidental or if we're selling something else. But we'll just keep doing that. That's what we've been doing for 58 years, and I can't tell you what the Fed was doing when I was buying Berkshire day by day or week by week or month by month or year by year. We were buying Berkshire, and and we've kept buying things, and we don't make stock market guesses, and we don't know how to profit by looking at broad statistics and guessing. We're in a way different position than we were when essentially what the option was to get 4 basis points on bonds, and that changes the value. It changes the value of real estate, changes the value of equities. It changes everything. But that's all happened in my lifetime, various ways, all the way up to a 21.5% prime and down to 0, which nobody thought we would ever get to. You can read the economic textbooks of like Paul Samuelson, a wonderful man, and it's a 900-page textbook that every kid went to school with, and you look for negative interest rates in the index, and there's not a word on it. I mean, so anything can happen, and we're prepared for anything, but we like to do things. Over time, we want to buy good businesses. It's that simple, and we always want to have money. If you lend money to somebody, and it comes due and they can't pay. The old story about the banker. I never made a bad loan. Of course, some of them turned bad after I made them. I mean, and that's exactly what happens in, whether it's in commercial real estate. And if money rates are 2%, or we were lending money out at 4 basis points at Berkshire to the federal government, not much more than a year and a half ago, or something like that. And if those rates change, let the person who bet that they wouldn't change lose money. I mean, that's if you make mistakes in business, plenty of people make mistakes. You pay for them. If you've got a big profitable business on top of it, which a good many banks do, you take your losses and you keep going on. I mean, banks can take a lot of loan losses, but they can't take something that wipes out their capital and expect the world to ignore that fact. The people who lend too much money should take losses, and they're getting properties handed back to them now. I mean, within the last month or 6 weeks.
Banks are.
Yeah, I mean, they got some office buildings in Los Angeles, and Blackstone walked away from something. I mean, and if you get a non-recourse, everybody goes in the real estate business. It's told the first rule, the second rule, the third rule is never sign your name to anything. And so you have non-recourse mortgages, and they're going to walk away, and the bank's going to get stuck with losses, and maybe they'll hold the property a long time, and it'll come back. And there's all kinds of ways that if you got capital strength, you may decide, well, I'll just hold it. But that money is sterile for quite a while, and that's part of banking. I mean, you expect to lose some money in banking. It's not a sure thing on every loan, and you build that into your calculations, and then you have capital that protects your depositors from eating into their money. And if it does eat into their money, then the FDIC, which is in effect really a mutual insurance company of a very peculiar sort, essentially spreads the losses among the continuing banks by higher FDIC assessments in the future.